Did you hear about the unexpected growth in China's economy? They say it's all thanks to their factories. Now, isn't that a plot twist? Just when we thought the dragon was taking a nap, it surprised us all with a big yawn. In the first quarter of this year, China's economy grew more than anticipated. And guess who we have to thank for this unexpected twist? That's right, it's their ever-busy factories, churning out goods faster than you can say, made in China. But here's the interesting part. It's not just about manufacturing more stuff. It's a strategic move by the country to counter a sluggish domestic spending and a looming real estate crisis. By heavily investing in new factories, China is essentially saying, if you can't buy our houses, then buy our goods. However, this isn't a simple game of monopoly. With increased exports comes the concern from foreign countries and companies about a potential flood of Chinese goods impacting their own industries, but that's a story for another time. So, if you've been wondering why your Made in China tags have been multiplying recently, now you know why. But wait, not everyone is thrilled about this. Foreign countries and companies have been raising their eyebrows, and it's not because they're trying to perfect a new TikTok trend. They're worried about a potential deluge of Chinese goods impacting their own industries. Picture a tidal wave of Made in China labels sweeping across global markets. It's a daunting prospect, isn't it? Now let's talk numbers. China's National Bureau of Statistics reported a 1.6% growth in the first quarter of this year. That's like going from 0 to 60 in a flash. Projecting this pace forward, they're eyeing an annual growth rate of about 6.6%. That's like sprinting a marathon and still having enough energy to do a victory lap. But remember, every silver lining has a cloud. This rapid growth could mean an influx of Chinese goods in the global market. Imagine waking up one day and finding everything around you, from your coffee mug to your office chair, all hailing from the Middle Kingdom. Quite a scenario, eh? But hey, who can blame them? A sudden influx of Made in China goods can be quite a sight to behold. Now, let's switch gears and talk about retail sales. It's not all sunshine and rainbows there, folks. The recent data shows a modest increase of 4.7% compared to the previous year. Sounds pretty decent, right? But hold your horses, because the devil is in the details. There was a particular weakness noted in March. Now you might be wondering, why the sluggish performance? Well, there are a few potential culprits. We could point fingers at the real estate crisis or the high debt levels. We could also blame it on the aging population or the disappointing economic reopening. But let's not forget about the impact of the stock market turmoil and the deflationary pressure. It's like a roller coaster ride, but without the fun and excitement. So, while the factories might be churning out goods faster than a squirrel on a caffeine high, it seems the retail sector is moving at more of a tortoise pace. Who will win this race? Only time will tell. Well,